Let everybody get settled in here and into the Zoom room. Hope everyone's having a excellent Wednesday afternoon or morning, wherever you are joining us from. My name is Brian Windsor. I will be your MC for today's discussion on retirement income planning. We'll spend some time talking about Bogart Wealth, the firm that's given the presentation today. Get you accustomed. This is your first time. Great. Want to introduce ourselves to you. Thanks for joining us today. Then we're going to get into the more heavier part of the conversation. We're going to focus on all the ins and outs of retirement income planning. We're going to spend some time talking about key risks that retirees face, why have an income plan, and then sort of talk about, what are the specifics of ways we can take cash flow out, or how to structure retirement cash flow, and the order of how things should be done, what types of taxation we should be mindful of, and even we'll talk about the upcoming tax bill. Actually, the tax bill that just got passed. We'll talk a little bit about how that might be changing a little bit about what your financial plan looks like. I think we're getting started with everybody here. That's great. So welcome. Again, name's Brian Windsor. I'm one of the certified financial planners here at Bogart Wealth. If you see me drink a lot of water right now, it is only because there's a Chipotle spread right before I jumped over here. I made a quick meal, and then I don't know, you get a sauce and you pour it on. I think I put the hotter sauce on there that I wasn't typically used to. So we're still in the calming the mouth down phase right now. But you guys are with me. We're going to get through it. It's going to be a great discussion today. So let's get started. Let's jump into the presentation. I am going to open the question and answer box as well. So if you see it on the bottom of your screen, if there's something that I say throughout the presentation that I should elaborate on, or something, or just another question that you have, feel free to pop the question into the question and answer box, and I'll be monitoring that through the presentation. Okay, let me get my slideshow ready to go for you guys, and we'll jump in and get started. So let's start with sharing my screen. Perfect. Cool. Looks like you guys can see that. Let me make sure I got that question and answer box open. I'll see what happened to that in a second. Okay. Retirement income planning is what the topic that we're going to be discussing today. And I work for Bogart Wealth. We are a registered investment advisory firm headquartered in McLean, Virginia. We have offices also in Texas, but we work with clients nationwide and actually worldwide. I have several clients that live internationally. If you're new to our firm, our mission is to help clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. $3 billion size firm, over close to 1,400 households throughout the country look to us as their primary financial advisor, their primary wealth planner. And we are a fee-only fiduciary. So we only generate revenue from what our clients pay us. And so we like to think that within clients, we don't sell products. We're not incentivized to do those types of things. So it allows us to put ourselves in the same seat as our client. We custody with Charles Schwab. That's our custodian. So if you are an existing Bogart Wealth client, glad you're joining us today. And they know that that's where we custody our clients' assets out. Okay. Let's get into some of the big headliners of the firm, just who our leadership team is. If you don't know the story about our CEO, our Chief Executive Officer and founder, James Bogart, I'd highly encourage you to listen to what really drove me to the firm. There was a podcast that he was on back in 2021, maybe, with Michael Kitces, who's a big name in the financial advisory community. And James's story of how the firm got started and the transition point is just an amazing and compelling story, and really exciting place to work at. And just in the last 3 years that I've been with the firm, about almost 20 years in the industry, I've seen this firm grow leaps and bounds, and it's all due to a lot of his leadership. And building that out is a wide range of advisors located both in McLean and Houston. Again, we work with clients all across the country and the globe. Um, if you're a client with us, you know this. If you're new for the first time, we typically do everything in house. I mean, our mission is to collaborate between the financial plan, the investment strategies, and the investment management that goes behind it. And for us, we do everything in house. Our team, this is our portfolio management team here, led by Alex. We don't farm out our investment management or financial planning or operations to other teams. It's a very cohesive unit here in the headquarters, at least with McLean and also down in Texas. I won't bore you with all these beautiful people, but just a wide range of individuals here that help us serve our clients, from our operations team to the financial planning team, all the way to those, individuals that are, running their own departments on marketing and business development and such. I'm sitting behind this building, but I am currently on the 9th floor, about 3 windows away from where my cursor is, down in McLean, Virginia. It's not so hot today, which is good. I don't know how the weather's down with a lot of other clients down in Houston, but recently I heard it's been quite warm for them as well down there. But that's where we are. We're headquartered in McLean, and have offices down in Houston and Gessner. If you're in this and you want to know more, obviously, if you're peeking into retirement income planning with Bogart Wealth, there's some interest on retirement planning. The ask in a lot of this is that we do work with our clients to help build financial plans and do the analysis that we're going to get into today. But if we're sort of a little shy about making that leap, I get it. There's a lot that can be there. We want to be able to help and provide education. Is one of the foremost critical things that we want to do for the public. Our retirement readiness series is available on bogartwealth.com, but also keep following however it is that you found about this, whether it was email or LinkedIn, social media, because we're consistently putting out new content and new webinars. One quick thing too, I'll do a quick plug for. If you haven't seen the invitation for the webinar that we're doing specifically on the new tax bill, that's happening on Tuesday. James Bogart, Patrick Marchenko, and one of the individuals from Charles Schwab actually is going to be joining us for a live 1 hour. That's going to be on Tuesday morning, 11 a.m. Eastern time and 10 a.m. Central. If you don't have the link and you want to get in, go ahead to either shoot me an email at bwindsor@bogartwealth.com or go to bogartwealth.com and hit contact us. We'll make sure to get you signed up for that. Okay. Feeling good. So that covers a lot of the introductions, and let's get into more of what we're here to talk about. And as we're talking about retirement income planning, we can't be ignorant to the fact that this is one small piece to the overall financial planning puzzle. And what you're seeing here on your screen is really at the heart of what we do, and how we work with our clients on that ongoing basis. Starting with assessing where you stand, making sure that we have the right cash flow in place, understanding how that cash or that income that you're taking is impacting your taxes, and based off of when these assets or sources of money are needing to be used for cash flow, how should they be managed, right? Should I be managing these differently based off of the taxation of these monies or when we're going to be taking it out? I say it is. And then also, how's your estate plan figure into all of that? And then review and monitoring, right? We just had a new tax bill come through. What changes do I need to be making? Clients of mine, I know you're on this. I see some of the names here. We're looking at this. If you haven't, obviously we just got it 3 weeks ago, but that's what we're working on now. Is on our next financial planning reviews is really assessing the changes that this tax plan is making, and really assessing, do we need to be making any changes to anything? Um, yes, Denise, I got you. Thank you. I will do that. So the topics today that we're going to be covering are going to be, well, first, Brian, why do I need to create the income plan? Tell me why. Well, we will. But and then, you know, what are the most common concerns that we get? And then also, what are the key risks that retirees face? We have a more successful plan when we understand the risks and have a plan to subdue those risks. And then what goes into building it, right? We talked about that puzzle here just a few slides ago, but what goes into building that said retirement analysis and investment strategy and such? We're going to be able to cover that today. Um, okay. All right. So why an income plan? If you're here, you're serious already about this. I don't need to tell you the why, but the benefits that we seek from this are just more of a better understanding of what our wealth can provide and what we should be doing to be good stewards of the wealth that we've created. We worked hard and there's a lot of sweat equity and sacrifices that we all make. I'm a parent of three. I know what it's like to make those said sacrifices. But in the end, once you know that you're have a financial plan and you know that you have enough money to pay the bills and everything is in place, having that fundamental plan is going to be pivotal to really understanding how you can view your wealth or how you can enhance your wealth, whether it's benefiting your lifestyle or benefiting your legacy. That financial plan is absolutely key to be able to start the building blocks, the foundation. Make more informed choices about your retirement, and then making sure things are sustainable, you're not taking out too much, and then monitoring. I mean, that's so critical, right? Just in the last 5 years, right? We've had changes with estate tax laws. I mean, drastic and how your heirs inherit money. That changes a lot about how we have to think about tax planning. And then, new tax bill that just came out where, for the last several years, we've been assuming that tax rates are supposed to sunset. Rates are the brackets are going to go down, but the rates are going to go up. That's not the case anymore. So how does this change, right? So this having an existing plan and then being able to pivot off that, I think is really pivotal. And it's different. It's different when you're in the accumulation phase. Generally speaking, the accumulation phase is one that certainly is allowing us to consider growing our wealth. And I hear it all the time for clients that are on the younger end where they're not needing these assets. When you get those market corrections, think about what happened from like late February to early April with all the ups and downs. For those individuals, that's actually great. Hey, saving my 401k, I'm going to get things at a lower price. I don't need it right now. It's a different story when you're, getting to the, 10-yard line of retirement and you're thinking about, okay, how do I get this over the edge? And I don't want any big downturns to impact me. And then all of a sudden it's thrown right in your face. So having that plan in place to me, is a plan to succeed, and not having a plan as a plan to fail. All right. Let's talk about what some of those concerns are. Maybe you have them or had some sort of feelings. I know I looked over these the other day and I hear a lot of them. You're looking from a report done in 2023. Workers that, individuals that are still working but are 50 years or older versus individuals that are retirees. Those retirees are in the darker color. Those that are working are in the lighter color. And it makes sense, right? The greatest fear for individuals that are still working is outliving my savings. Think about that. Like it's a terrifying feeling. If you have kids and being a burden on them, or what if you don't? What if there's nobody? It's a scary feeling. Obviously, that number goes down when you're retired because then those individuals actually retired. They probably feel a lot more confident about being able to make those changes. But other things like Social Security, healthcare, specifically, cognitive decline, losing independence. I mean, these are serious things. And if most individuals that I work with have, some sort of individual that is close to them that have seen these things, and it's It's hard. It's certainly hard. And there's I think one of the other ones that I get that I don't yeah, this one I get some often is finding a meaningful way to spend time in retirement. I always love that. I don't know what I'm going to do, Brian. I don't know what I'm going to do in retirement. And it's always funny. Those individuals always end up having some of the best retirements because once that door opens and they step through that gate and that sounded pretty morbid. The retirement gate. I have fun. No, but those that enter retirement, they just wish they did it sooner. Um, what are the factors that go into creating your plan? What's important to you? Your situation, your storyline is going to be different than everybody else. How your neighbor approaches retirement, how your parents approach retirement should be drastically different. Heck, even how your spouse approaches retirement uh, may be different. How's your family, right? When you think about retirement, how's your family impact all of this? You know, do you still have parents? Are they, are they still here? What does that look like? Um, children, how young are they? What other upcoming expenses may they have that you really want to make sure that you're helping them with? How's health? Mentally, physically, that's going to change. Retirement's going to just like anything in life. Things are going to change. What's living situation look like? It's so funny. A lot of times you hear about this retirement, and there's like these photographs, and heck, I think we have it on our website too. Ours is like this water and this sailboat, and that's it, and that's what we're doing all day. That sounds great. It's advertised, but most clients are family oriented. They want to travel, and they don't want to have to worry about money. But do you want to buy a second home, or those sorts of things? Um, you know, uh, Grandkids make a big change. I was just talking to a client this morning about purchasing a second home, possibility of grandkids. What's the lifestyle that you want to live? Like zebras don't tame stripes. You usually spend the same way that you do in retirement, before retirement, maybe a little bit more in the first few years. We'll talk about that. That's the go-go years. We want to really enjoy the fruits of that while we still can. For some, it's still working. A lot of times it's legacy. I mentioned lifestyle versus legacy, but if you have kids, how important is that? And quite frankly, a lot of this planning that we do allows our clients to see how their legacy expands over time. We have some interns here, and I was sitting with meeting them today, and it's they're told in school it's all about maximizing that end of life number. How can we push that number to be the highest? And I was telling them yeah, that's the case, conceptually, mathematically, but most parents, 60 to 65 years of age, maybe even older than that have kids. I'm consistently hearing more and more now. I'd rather see that for them to be used now versus them getting it, say 20 or 30 years from now. Well, how does that all fit into what you're doing? And actually, how does that fit into your cash flow plan? Because it can change things. So it's really important as you're starting to think about all that through. And then, mind and spirit, what do you want from retirement? You're grown up now, right? What do you do? It's a tough question. Most people find the answer pretty quickly. See if there's any more questions. Nope, still good there. Key risks of retirees. We used to call it Wilma, like the Flintstones characters. Here, what is it? LIMA. Well, that doesn't really mean anything. But longevity, inflation, markets, and health. It's pretty. Look at this. If you look at some of those risks of what could derail your financial plan, it's longevity. There's a 40. Sorry, there's a that oh yeah, 42% chance that one between you and your spouse is going to live to the age of 90. 16% chance in 95. I mean, that's especially if you have monies that are invested, right? It's like, I need to make sure that this lasts a very long period of time. We've been through a big bout of inflation recently. A 3% inflation rate over a 25-year period slashes your purchasing power in half. In this case, 50 grand down to 23.8. Market performance, things that you don't have control over, right? You enter retirement and you go through years like 2000, 2001, 2002, where you had consistently 3 negative years in the S&P 500. It's pretty tough. Pretty tough to go out alone and not have a plan for that or how to address the volatility that we saw just a few months ago. And in healthcare, the average couple spending about 330,000 in retirement. That's not including nursing home expenses. So, I mean, there's these other things that could just happen. And then, outside of this is just, family things, life events that can occur that we just don't know about. Um, so retirement income planning, what is it? What does it mean? How do we go about it? Well, it allows us to analyze your data, do projected forecasting, and then determine how do we enhance that based off of what's most important to you. How do we synergize that, that quantitative information with the qualitative side of your life, right? That's what the financial plan does. It brings that into place, and having an advisor, typically a certified financial planner like myself, is going to help you gravitate in towards implementing that and then consistently checking in on that. That's what our messaging is, at least. And that's how we go through looking at this. It's, spending, lifestyle, taxes. It's a really big part of what we do, which I think that makes us unique, is that synergy as well with how we approach taxes and tax planning. Retirement income planning is not a process. It's an event. Sorry, it's not an event. It's an ongoing process, right? So you see the screen here. It talked about, hey, cash flow fits into this piece, but hey, it may need to be changed. It's not just set it and forget it and it's done. Things change. Your lifestyle changes. Tax laws change. Life changes, right? So, getting back to the drawing board. So let's start with how we get started first and foremost. How do we think about prioritizing what is going to be most important to us? Defining what makes your retirement unique. And it's, for the one client I was talking today, it's, I want to be there if my daughter has kids. And, she's already said that she wants me to be there for a few months before and after. And she's like, realistically, I want to be able to be there for her for, at least a year or two. I want to have my own place. I don't want to be a burden on her. I tell her, for someone that has young kids, having somebody in there, if you're on an own little island with kids, just having somebody else to be there to help out is exponentially great. But, a lot of times for clients and they're prioritizing these set goals, it's trying to understand how retirement's going to evolve, and your expenses are going to change over time. It just does. And it's you may think of, I want to make sure my expenses can go up with inflation. I get that. That's what we do. But a lot of times when we think about how we're living our lives now, those things will change. Usually they get lower. I mean, over time, you see, how the individuals, while they're leading up to retirement, that demographic of 55 to 64, they're spending X money, but then those newer retirees are spending less on other expenses. They're not driving as much. They're not needing much as clothes. 16% down in food and alcohol. That I question. I was just down in New Orleans this weekend for my brother's wedding, and I would tell you the demographic of 65 to 74 was not negative 16%. Maybe sample size is the issue, but it certainly looked to be different. I think the bigger one to be monitoring here, though, is healthcare, right? And that's the one caveat of things that typically increases a lot more so over time. So within our financial planning tools, when you're working with us, we elevate those costs much higher than everything else as far as standard levels of inflation. All right. So we've talked about understanding our expenses and sort of building out what that might look like based off of the retirement that we want to live. First few years of retirement typically are the go-go, say that first 10 years, then the next 10 years slow go, and then, the no-go as we're aging. Income's going to come in from a couple of different places. For all individuals that have at least 40 quarters of work in the United States, Social Security is a big factor of that. For the average individual, it replaces about 40% of their pre-retirement income. It could replace anywhere from any individual from 9 to at least 1%, theoretically, I guess. If you had a really high salary. What's being reduced over time is the defined benefit pension plan. Dad, granddad, they may have been working, and you put your 30 years, 35 years in, you qualify for the pension. And then that's, based off a formula, typically a certain percentage based off the years of service and your salary. And then that's guaranteed income for life for both you and your spouse. And that was, traditionally just the way it was. But very expensive for employees to maintain that. And they've been moving individuals off those plans. And right now, about only 15% of individuals right now have access to a defined pension plan. So where does that come from? Well, the gap must be made up from us, from our investments. So think about things like our general investment accounts, our retirement accounts, like 401ks, IRAs, for savings plans, those sorts of things. So it's on us, right? It's on us to be able to, make sure that we have our investments to cover our bills. This is a pretty heavy graphic, and it's very large. Emotions can destroy your plan. It's true. Maybe we could have not completely italicized that and maybe done some lowercase letters here. But no, that's true. Emotions can certainly bleed into making, overreacting to decisions based off of, really headline news in a lot of ways, whether that's for fear or for greed. Um, that can do really the contrarian thing that we want our clients to do. And when you do that, when you make those moves and maybe a negative event happens, there's really a hard time coming back from that. So think about just a few months ago. What if on April 8th, that was your day of saying, you know what, I can't do this, I'm out. This is just too much. Um, Luckily, all my clients, none of us did that, but let's just say that we did. What have we missed since then? I mean, we accepted a loss when the market was like close to 20% down. I mean, since then the market's positive. I mean, we're higher than we were in peak in February. We had all-time highs now. So it's those types of emotional decisions can absolutely derail the plan. And why I think it's important to understand that you have a financial plan, you have a plan in place based off of, the cash flow needs that you have, but also the way that you envision the way that cash flow is going to flow. And so we're going to talk a little bit about that in the next few minutes. Um, let's see here. Um, yeah, so good question. Future of Social Security. There's no ifs, ands, or buts about it. Social Security has funding issues. It was originally put in place in the 1940s. During that time, there was 5 workers for every one individual that was projected to be on Social Security. Individuals, it was called old age insurance because you live the maximum age at that time, which was life expectancy was 60. Now life expectancy is much higher, and there's a lot of individuals that typically, if you're on this seminar, you've done a good job saving, you've taken better care of yourself. Good chance that you're going to live a long life. It was never meant to be designed for that. And right now, we have only two and a half workers for every one individual on Social Security. That number is expected to decline. So there's certainly funding issues. It's not saying that Social Security is actually going to go away, right? So there's a couple things for Social Security reform that may or may not be done. Right now, if nothing is done, you'll see reduced benefits. What, in years, some in 2033, 2035, and then that covers some of the funding issue because everyone would get a pay cut. But theoretically, what's going to happen? And if you look at Social Security reform that we had, in the 70s and 80s, a couple things may occur. Number one, you might see the expansion of the age of your full retirement age. Right now, it's 67. Um, I'm prepared that number for me personally is probably going to go up to 70 or 72, and then you can currently delay to 70. I'm prepared for that number to be, say, 75 or 77. That's going to solve some of the funding issues. And there's also taxation on Social Security. Right now, it's only taxable up to the first, $168,000 of income. Could get rid of that cap. Now, that's obviously a work for Congress to do, but that also would save a lot of that or increase a lot more revenue. So there's certainly reform that I think is going to occur at one point or another. What I don't think is going to occur is individuals that are either on Social Security right now or nearing to use Social Security. I do not think that their benefits are going to be reduced because I think, just from anything, it's a voter problem. But for those that are maybe, 15, 20 years out, maybe that's going to be the case and that's going to change. I was thinking the French. Do you guys remember when they were going to increase the pension year by 1 year and they started rioting in the streets? Um, I don't think the U.S. is going to do that. We're not like the French, I guess. Um, All right, so let's talk about investment strategies. What are some of the basic things that individuals may look to do to drive cash flow in retirement from their investments? Five basics. We're going to talk about annuities. We're going to talk about fixed income ladders. We're going to talk about other income oriented investments like dividend stocks, and then lastly, we'll round it up with my true beliefs, which is fixed asset allocation or more just a dynamic asset allocation approach to investing. So not saying that one strategy is better than others. Everything has pros and cons to it. And we're not here to recommend anyone. We're here just to explain exactly, what are the different ways and, how that can come about. So first with annuities, couple different ones that are out there. There's income annuities and then there's deferred annuities. Deferred annuities is that money's for income in the future. I'm not using that now. And then there's income annuities, which is kind of like your pension. I'm going to take a portion of my money and I'm going to give it to the insurance company. And in turn, they're going to promise me X amount of dollars for the rest of my life, my wife's life, or 10 years, 20 years, whatever it is. Those types of annuities are, think about those fixed annuities as like a bank CD, and you get a fixed income that comes from that. And then index-based annuities are ones where you invest the money with the insurance company, and based off of the underlying returns of the portfolio that you are invested, you'll get returns. Now, what they do is they promise you, hey, you won't lose below X%, or you won't lose, more than this. But how they get you is they cap you on the upside. So the markets have good years, you're only capped at a certain percentage point. That's really where they get their money. And then there's variable ones that are invested, and then your income can go up or down based off of the underlying performance of the investments. But usually those have a little more flexibility. So we said about annuities. Annuities are more of a predictable way of generating money in retirement. Next, bond ladders. What's that strategy look like? Well, basically, simply put, I'm going to buy the same amount of money or maybe different amount of money over different periods of years. So in this case, I don't know, let's just throw $10, just as a simple number. I have $10 here in a 1-year investment. When that comes due, I'm going to buy a 3-year investment. And then with other money, I'm going to buy a 2-year investment. And when that comes due, I'm going to buy a 3-year investment. So every single year, I have a pocket of money that's coming due towards me. I can live off that interest, right? And I can always have money coming due if and when I need it as like a lump sum. So that's one way of, using this as a way to say, hey, my principal is protected. I'm not putting all my money in one specific time frame to avoid the risk of reinvestment risk. What if interest rates plummet and then I have to put all my money in at a certain time? I'm just going to stagger it and get a more true average representation of what interest rates look like. I remember a client of mine in 2018 was doing something like this, and we talked about going a little bit longer on the yield curve because rates looked favorable. Nope, I want to stay on the short end. I don't want to go long term. And then interest rates plummeted. And then so he had a bunch of his money come due and he didn't know what to do. It was sort of paralyzed. So making sure that it's not just a 1 to 3 year, typically there's more rungs than that, more years than that. So working with a professional would certainly be helpful if this is more of a preservation of principal strategy for retirement. You lose some growth though, right? So there's that cost benefit there, right? I'm going to get guaranteed or, principal protection here, but at the same time, I don't get that growth. Okay, what was the next slide we're going to talk about is income-orientated investments, dividend-paying stocks, common stocks, and MLPs and such. Let's pop over there. So income-orientated investments, we can see things like the S&P 500. Unlike the income-oriented strategy, which is fixed principal, this is an investable asset. And you can see how the S&P index has increased over time. This is as of the end of June. But you can also see the dividends paid from the S&P 500 and how they've grown over the last 25 years or so. Dividend income inflows or dividends paid out have increased by 6.5% in the S&P over the last 25 years. So when we think about it, it's like, hey, an investment that might help keep up with inflation and also pay me income and also give me some market participation. There's obviously volatility accordingly, but we've seen the markets grow their dividends over the last several years. Then lastly, fixed allocation and then dynamic allocation. Very similar. They're like brother and sister, or maybe cousins. Fixed asset allocation, if you just think about modern portfolio theory, that traditional X% in stocks, Y% in bonds, traditionally maybe a 60% stock and 40% bond portfolio. That 60-40 mix, if stocks go up and you make money, excellent. No matter what's happening, you rebalance, you sell those stocks at a profit, and you buy bonds back in. Vice versa, if stocks go down, you are selling those bonds to then buy stocks at cheaper prices, unbeknownst to what's actually happening in the environment, in the world. Now, dynamic asset allocation approach looks at various economic indicators to determine, hey, what's the risk of the market right now? What's the feel of it? What's the fear? Is now a time when that portfolio can take a slight amount of risk because conditions will look really favorable, or vice versa? I think things look pretty overheated right now. Maybe we need to pull back a little bit from that traditional approach. Again, we're not talking about big seismic shifts, but maybe 2 to 5%, 10% in extreme conditions, over and under. Yeah, absolutely. And that's one of the investment philosophies that we have here with the firm. So we've been able to define several different ways of taking income. So annuities, bond ladders, fixed income approach, dividend stocks, or sort of a combination of everything with a fixed allocation strategy or more of a dynamic allocation strategy. Sort of the ways to structure your investments to gain cash flow. But what's the strategy then to say, okay, well, what should I be thinking about? Now, again, income is each strategy, I should say, is going to have some benefits. It's going to have some drawbacks towards it. That first one that you're seeing is an income only. We've sort of mentioned some of that. Is that the income only strategy is that I have a fixed investment. Now I'll show this here, like a bond ladder and even dividend paying stocks, where let's just say in this example, $1.5 million, and I need $60K. If I get Social Security, that's going to solve for about 24 grand. I'm going to do a bond ladder at a 2% yield. That's pretty low considering rates right now. But for discussion's sake, let's say that that's the case. Give me 15K, and then my other 750 can be in dividend paying stocks. Drawbacks? Well, drawbacks are you're missing other places in the markets. So if I'm just focusing on bonds and fixed income and just dividend paying stocks, I'm missing a lot of the opportunity that's been happening in the market over the last several years. Think about the emergence of AI that really got us out of the doldrums from the 2022 downturn, where we saw both stocks and bonds at a negative point for that year. That emergence of tech stocks has really lifted up the markets and the economy of the last several years. If this was your strategy, you may not have been able to fully participate in all of that. So there it comes with a cost trade-off. I have more, security of income from things like dividends, but I also may lose some things like market participation from other sources. Another approach that we looked at on that first screen was a strategy 2, which is systematic withdrawals. Well, that's where I'm going to go to my allocation-based approach portfolio, and instead of doing the dividend only and doing just bonds only, I'm going to do a diversified portfolio, say 60% stocks and 40% bonds for my $1.5 million. And I'm just going to take out $36,000 a year, whether that's just from income or gains. That's what my strategy is. And that's going to be about a 2.4% withdrawal rate. You'll hear me in a second say why withdrawal rates are important to understand about your plan. But that's one strategy where you're saying, hey, I'm going to take a portfolio. And generally speaking, as long as you're under that 4% mark, that's, may not be a strategy that's bad because, yeah, you may not have some guarantees. You may not have that fixed income in there. Um, but generally speaking, that lower withdrawal rate can lead to is usually sustainable over a long period of time. And you still have market participation. Here you'd have, you know, dividend paying stocks, you'd have bonds, but you'd also have some international, you'd have growth oriented stocks, small, mid cap stocks, and so on and so forth. So it gives you a lot more range for growth and also risk reduction too. That next strategy that was on that the strategy screen was from income only, systematic withdrawals. This is a bucket approach. This is where you get and having a bright plan in place is going to really allow you to see some of these monies and how they should be put to work. But you say, hey, okay, I got my retirement in front of me. I want to make sure that a recession or a major downturn in the market that happens early in retirement does not devastate me long term. Now, we never know what's going to happen, but I just want to make sure that, instead of doing that 60-40 approach early in retirement, I want to make sure that there's just money that's safe. Great. Well, you take the first couple of years, in this case, 1 to 5 years that you need, $300,000 for those first several years, and you put that in cash or money markets. I mean, right now the money markets are paying 4.14%. Now that may go down when interest rates go down, which could happen. So that changes, but right now it's a pretty it's an interesting, attractive place to invest. And then I have mid years, so there's some monies that I need in the midterm. So I want to make sure that I have that set aside. I still want to get some growth, so I'm going to have some more slightly diversified portfolio, sort of middle of the road, more moderate risk to cover those years of income. And then anything longer term that maybe is at least 2 market cycles away, average market cycle 6.5, 7 years. So at least 2 market cycles away with those monies. I'm comfortable taking the risk with those monies, and I'm more comfortable going to more stocks there because I might see more volatility, but over time I'm going to be thinking about better returns over time. So hopefully I'm compensated for taking that risk. So again, it's about the strategy. It's about how you set it up, the strategy you want to employ, and then next it's, well, how do I manage what source of money do I want to be withdrawing from? Because, hey, a lot of us have 3 big sources of money. We have our non-retirement monies, we have our retirement monies like our IRAs, our 401ks, and then we have our Roth, our after-tax savings that are growing tax-free. We have Roth in our 401k or Roth IRAs. Which one do I pull and why? Right? So general rule of thumb is you're non-qualified first, driving your tax rate down early to allow your tax deferred and tax-free assets more time to grow. It's a good rule, not always optimal. But no matter what you do, at the age of 73, if you're born in 1959 or prior, you have to start taking required distributions. If you're born in 1960 or after, that is the age of 75. But that makes you take out a certain amount of money from your retirement plans each and every year, and that amount goes up as you age. You can take more, you can't take less. Well, you can, but you're going to be penalized if you do. So it's important to understand with the wealth that I have, what are the rules behind the money that I have, and how does that fit into what and when I need to be taking my monies? Because once I know the what and when, then I can start building out what the investment plan looks like, kind of like what you see from this bucket strategy here, right? So not necessarily that saying this bucket strategy specifically, but understanding that how the sources of money fit into my financial plan is very critical, and what's my time frame associated with these monies. Okay. How does taxes work? How does that fit into this? We're going to talk about the new tax bill in a second, but for general rules of thumb, if you're looking to minimize taxes, things that generate ordinary income, which is at the higher tax rate. Ordinary income, you'll see that we have the marginal brackets of 10, 12, 22, 24, 32, based off of how you file and how much income you have. So generally speaking, you can see these brackets go up to 37%. Then there's a difference of capital gains or qualified dividends, which is either a 0, 15, or 20% rate. Generally speaking, it's the capital gains and qualified dividends are cheaper than ordinary income. So generally, then if I have tax inefficient assets that pay, interest income that pays, I might want to hold those in my retirement accounts because that stays in my retirement bubble. But if I have assets that, hey, are generating qualified dividends or just capital gains, and I'd rather have those in my my non-qualified assets because they're taxed at a lower rate. So asset location, right, is important. And then you see here, what type of income is taxed as what. Social Security, up to 85% of that is taxable. Typically 85% for most, some are going to be lower. If you have a pension or annuity incomes, typically taxed at ordinary income. IRAs, 401ks, distributions, also taxed at ordinary income. Roths are not taxed and not subject to taxation. That's generally speaking why we want Roths to grow the most and longer, because if you ever needed to withdraw it, there'd be no taxes ahead. Also has a lot of benefits for your heirs, which we talk about in other seminars that we have. All right, guys. So the new tax bill. I'm going to hit some highlights, but James and Patrick are going to do a much more deeper dive on Tuesday morning with this subject. Again, I encourage you to jump in that. Mainly, what does this mean for our clients and how does this make us pivot? Well, first and foremost, now we're projecting lower tax brackets and increased standard deductions. So for a lot of our individuals, 65 and older, or 60 and older, we're projecting a standard deduction of 33.5. Now we're projecting it to be 34.7. That's starting this year. Seniors, if you are over the age of 65, there is the enhanced senior deduction. For those that are single filers, if they make $75,000 or less, they also get a $6,000 deduction. There's a phase out between $75,000 and $150,000. If you're joint filer, then that number is $150,000 going up to $200,000. So each individual, it's each individual, not just total. So you and your spouse could, if your income is less than $150,000, you could each get a $6,000 deduction or $12,000 for that enhanced senior credit. Now that's actually that's temporary. That sunsets in 2028. So that's not permanent. That's just going to be for the next few years. State and local taxes are back. So previously it was limited to $10,000. Now it's been raised to $40,000, but there is a phase out for high income earners. That's typically about $500,000 or higher. Oh, hit the button. Gift taxes, state tax increased to $15 million per filer. So $30 million for a household starting in 2026. And keep in mind, there's portability between that. So for those that were worried about a sunset in the estate tax law, it was supposed to go down to about $7 million if the tax law didn't change. That's now permanent. So we now are not worried about that sunsetting at all. And then lastly, with charitable giving, a permanent above the line deduction of $1,000 for all charitable donations for individual filers, for joint filers, $2,000, subject to a 0.5% of adjusted gross income. So that's not even something if you're itemizing, that's something that all of us can take advantage of. So how do those taxes all fit into that? How does that fit into your financial plan? That's where it's critical to make sure you have the plan, working with a professional to make sure that we're doing everything in the right way. Adjustments that you need to be making, and my clients, they know this. We always look at financial plans from 2022 or 2023, and we're seeing where they are now in 2025. How are we doing? I mean, based off of the markets, and we're doing better, and so we're having those discussions on legacy. It's getting the financial plan done is not just a one time and done. I sometimes hear that from clients. Oh, I had this person, we did it, we're great, we're all set. Things evolve, things change. You need to have a check-in source, and that's for us, it's minimal, at least once a year, that we're making these updates for you on the financial plan. Generally speaking, that systematic withdrawal program that we talked about, this is a quick example on a conservative growth rate, conservative inflation mark. That historically speaking, that 4% is that rule of thumb. So for 5% withdrawal rate, generally speaking, maybe more safe for somebody that's 70 years old. A 6% withdrawal rate safer for someone that's about 80 years old. So how much money you can take from your portfolio can also change as you age. How kind of getting to the point of wrapping up, but this this screen is talks about, hey, how you can make adjustments, and hey, you can increase your income if things look good. You can turn it down, turn down cash flow if things didn't look so good. I don't buy this. You have the right plan in place and you take the cash flow into the lifestyle that you want, only allowing the market growth opportunities to enhance. Never want to see anything have to be pulled back if we can avoid it. Um, and then this kind of gives you some standard rules of thumb here on withdrawal strategies. So if you're going at it alone, some of the things that you may want to consider if you are self-directed, um, is to live off interest and dividends first. That's just free cash flow. And then withdraw monies from asset classes that have the most positive returns, starting with your equities, right? Taking those gains off the table, then cash, and then negative holdings, right? So you want to avoid having to withdraw anything on the negative front of locking in those losses, depending upon, what the reason is for those losses. Yeah, using the retirement plan helps you understand what your withdrawal rate is, makes sense. Are we taking too much? Are we taking too little? What's the withdrawal strategy that we're taking longer term? How should taxes be to take into consideration? I mean, all of this stuff increases the probability of having a more successful retirement, or at least a more emotionally less stressed retirement. All of this having in place allows us to avoid making those those emotional decisions, those overreactions, because you trust in the plan, you trust in the process, and you know that things are going to be accounted for and it's going to be okay. But having that plan allows us to have a placeholder in time to always go back to and run new numbers based off of new points in time. So you need to have a plan. How do you go about doing it? Well, that's where we could come in. An advisor here at Bogart Wealth is a certified financial planner. They know retirement plans, they know the IRS rules. We don't sell products. We're just here for helping managing your money by incorporating tax planning and financial planning. If you want to talk to us more in a one-on-one session, that's where you can reach out to us directly at bogartwealth.com. Schedule something on a one-on-one. If you're an existing client and some things that you heard today, I want to make sure we're updating it. I want to wait. I want to be more proactive until my advisor reaches out to me for our next quarterly review. Don't hesitate. Let us know. That's we're happy to help and meet our clients where they need us, and so that can be in person, whether it's here in McLean where I'm at, or down in Texas, or virtually at any point in time. So thanks for joining us, guys. That's what I have. I'll keep the Q&A box open for a few more minutes. I don't know if anybody else has any questions, comments, concerns, but I'll hang on for the next few minutes to see if there are any questions. And my mouth is not on fire anymore. That speaking for 40 minutes straight helps get rid of all the burning on the mouth. Oh, gosh. All right. Is there another new tax session planned? There's, Mark, if you didn't hear, there's going to be a webinar with James Bogart and Patrick Marchenko and one of the tax experts from Schwab. And that's going to be this coming Tuesday at 10 a.m. Central Time, and 11 a.m. Eastern Time. If you're unable to make, I'm going to make that. That's going to be put online. We're going to put that information on the website as soon as it's available. If you have questions on that, then you can reach out to James, Patrick, or myself, and we'll make sure to get those questions from that available to you. So it might not be the next day. Typically, it's a 2 to 3 day lag before marketing and compliance can get everything approved and then put on the site, but it will be there. It's a pretty big point for the firm to have this being taken care of. So yeah, we're good there. All right, guys, I think we're all set. If some people popping out, wish you guys well. Enjoy the rest of your day. And we'll talk soon, guys. See ya. Bye.